ACM Research dropped 16.6%, and everyone is panicking. The lab gave ACM Research a 66-point score, highlighting its proprietary megasonic cleaning that removes wafer particles without damage. That technology lifts yield and reduces rework, directly protecting margins. But the lab score is 66 out of 100. Why? Here's why the sell-off is wrong. ACM Research is flashing red on every monitor, plunging 16.55% to $97.77 as investors aggressively sell the news. The market is reacting to a post-earnings fallout where, despite a massive 69.5% Q1 earnings per share beat of 34 cents against the 20 cents estimate, momentum has completely broken. This sharp sell-off is driven by a broader market rotation under extreme fear, with the Fear and Greed Index sitting at 19. Capital is fleeing high beta, a metric measuring a stock's volatility relative to the broader market. Names like ACM, which carries a volatile beta of 1.98, despite its history of consistent earnings beats. The engineering reality centers on particle removal efficiency, the percentage of microscopic contaminants successfully cleared from a wafer at advanced process nodes, the specific generation of semiconductor manufacturing technology, to clean sub-10 nanometer structures without collapsing fragile gates. ACM utilizes proprietary megasonic cleaning, whereas larger Japanese and American rivals rely on older physical scrubbing that destroys delicate features. This technological edge justifies the underlying demand, but the physical bottleneck is mature node factory capex. Capital expenditure, the funds a company uses to acquire and upgrade physical assets in China. Because ACM systems are optimized for these older fabrication plants, any slowdown in Chinese mature node buildouts directly limits their shipping volume, confirming that market anxiety is grounded in physical supply chain limits. Quarterly financials showing modest revenue momentum for ACM by Q4 2026. Global trade protectionism will compress ACM Research's revenue growth from its current 34.2% down to under 15% as geopolitical friction restricts mature node fab expansion. The macro environment is acting as a severe friction point. While the Federal Reserve's current benchmark interest rate of 3.63% and a normalizing yield spread, the difference between long-term and short-term Treasury interest rates of plus 0.3% offer a stabilizing backdrop. They cannot shield ACM from trade policy shocks. Even with U.S. recession risk low at 8%, macroeconomic anxiety is mounting. This is because the company's capital expenditure pipeline is heavily exposed to escalating tariff threats. As trade war fears reignite, the risk of sudden tariff-induced cost spikes threatens to erode ACM's operating margins, directly contradicting the bullish demand signals from global foundry expansions. Geopolitically, ACM Research operates on a knife's edge. U.S. export controls, government restrictions that limit the export of sensitive technologies to foreign countries, force the company to rely on older generation chip factories in China. This dual-country corporate structure is highly vulnerable to rising U.S.-China political tensions. While this focus shields ACM from immediate advanced node bans, it caps their long-term growth ceiling. The social and political backlash against foreign technology dependencies is accelerating regionalized manufacturing. If Chinese government spending on mature node factories slows, ACM's primary revenue engine stalls. Despite TSMC's strong May revenue of 417 billion new Taiwan dollars showing robust global AI demand, ACM cannot easily capture this capital flow due to its structural concentration in China, making its high beta profile highly vulnerable to geopolitical shocks. ACM Research reported earnings per share of $0.34, beating the Wall Street estimate of $0.20 by 69.5%, a solid beat that signals strong execution. ACM Research is trading below its 20-day average, currently at 90. Management's headline: Accelerating Investments in the U.S. 3 words that appear in every prepared statement, earnings slide, and investor deck. They want you to feel the momentum. America is the future, AI chip demand is insatiable, and ACM is the picks and shovels play. What they don't want you to think about, that those investments are burning cash now, while margins compress and insiders are selling. Here's the decode. Insiders net sold 128,752 shares in the last 90 days. That's not a routine option exercise, it's a pattern. Historically, when executives dump shares while the stock is still near highs, it's not confidence, it's a hedge. And the timing? Right after a 69.5% EPS beat that Wall Street is calling a turning point. But look closer. That beat came on lowered revenue guidance. Management is spinning a margin story while the top line softens. That's not a turn, it's a pivot. The EPS beat is a mirage. Yes, they crushed estimates by 69.5%, but R&D as a percentage of revenue jumped to 16.1%, up 37.5% year over year. That's not efficiency, that's desperation. They're spending more to chase a market that's already pricing in perfection. Meanwhile, Morgan Stanley just raised their price target to $130, but ARK trimmed its position. The sell side is cheering, but the smart money is quietly stepping back. And here's the engineering reality. ACM's tools are critical for advanced packaging, but the bottleneck isn't demand, it's yield. The momentum breakdown for ACM Research. RSI sits at 53, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bullish, with the histogram crossing above zero. ACM Research's bull case rests on its proprietary megasonic cleaning, high-frequency acoustic wave cleaning used to remove microscopic contaminants from silicon wafers, technology which removes particles without damaging fragile architectures. This unique process allows ACM to win customers in South Korea and Europe, diversifying its revenue while maintaining an impressive earnings per share beat streak. But here's what breaks the bull thesis: extreme geographic concentration. ACM's revenue heavily depends on Chinese mature node fabs, semiconductor fabrication plants that manufacture older generation chips, which are highly vulnerable to sudden capex. Capital expenditure, the funds a company uses to acquire and upgrade physical assets, freezes. Smart money is exiting, with Invesco trimming its position by 41%. The pro-level question is this: can ACM qualify its tools at advanced foreign fabs fast enough to offset a Chinese slowdown? The lab's answer is no. Tool qualification, the rigorous testing process required before a semiconductor manufacturing machine is approved for mass production, takes up to 18 months. ACM's dual country structure faces intense regulatory friction, meaning foreign expansion cannot scale quickly enough to prevent near-term revenue contraction if Chinese spending stalls. Our conditional call is clear. If ACM maintains support at $76.29 through Q3 2026, the stock will consolidate toward $100, pricing in a gradual international transition. But if Chinese mature nodes spending drops before then, expect a decline to $55. With an AI score of 66 out of 100, we expect the downside scenario to play out as post-earnings momentum fades. Here's the macro picture shaping ACM Research. U.S. export controls on advanced microchips force ACM Research to focus on older generation chip factories in China, which currently shields them from direct bans but limits their high-tech growth. Meanwhile, potential new tariffs and rising U.S.-China political tensions threaten to disrupt their dual-country corporate structure and supply chain. ACM Research specializes in high-tech industrial washing machines that clean microscopic dust off silicon wafers, a crucial step since a single speck of dust can ruin a $1 million microchip. They face intense competition from larger Japanese and American rivals, but are winning customers by offering unique, damage-free cleaning technologies. Over the next 6 months, the biggest growth driver will be their expansion into new markets like Europe and South Korea, which would prove they can succeed outside of China. Conversely, the main threat is a sudden slowdown in Chinese government spending on mature node semiconductor factories, which would immediately hurt their primary source of revenue. ACMR's 200mm silicon carrier yield just hit 94%. That's the signal no one's talking about. Wall Street sees revenue, we see margin physics. Every point above 90% drops COGS 12 cents per wafer. That's free cash flow falling straight to the bottom line. Are you holding ACMR? Drop your entry price in the comments. This isn't financial advice, it's engineering context. Markets move fast, data gets stale, and past performance never guarantees the future. Do your own research before you trade. If you want our full breakdown on Rocket Lab, the link is in the description. Subscribe so you don't miss Thursday's deep dive. We're tearing down AMD. The lab's work is never done.